Thank you for being here. Welcome to our conference today. I want to really thank you for joining us today at our panel on next steps in offshore multinational corporate tax, presented by the Levin Center at Wayne Law. I'm Lance Gable. I'm the interim dean of Wayne Law, and I'm just thrilled to welcome you today to our panel. I want to especially thank our panelists, who you'll hear more about in a minute, and I also want to especially thank Senator Carl Levin, who is the chair of the Levin Center at Wayne Law, and also Dr. Tom Coburn, who is a member of the Center's advisory board. This is going to be a very interesting conversation, obviously very timely, with all the policy issues that are in play with the new administration coming into place. And it's now my pleasure to introduce Jocelyn Benson. Jocelyn is the director of the Levin Center, and she's also the CEO of the Ross Initiative in Sports for Equality. From 2012 until 2016, she served as the dean of Wayne Law, and it's my pleasure to welcome her to the podium.
Thank you, Dean Gable. And I'd like to echo Dean Gable in thanking Senator Levin and Dr. Coburn for co-chairing today's conference and for being a part, Dr. Coburn, of our Levin Center Advisory Board, and to the rest of our panelists for joining us, and to Elise Bean, who led the way in really bringing us all together today and planning this. Thank you, Elise. This is the third national conference sponsored by the Levin Center, and I cannot think of a more timely issue to discuss today. I'm happy to introduce the moderator of today's discussion, who will be Elise. Elise is the Washington co-director of the Levin Center, and one of her major contributions to the Levin Center, in addition to planning today's event and many other similar events, is that she leads our bipartisan training for congressional staff on the art and practice of oversight and investigations, a critical issue in our current climate. In addition, she's traveled to Brussels and Ukraine to conduct similar trainings at the international level, and of course, for 11 years, from 2003 to 2014, Elise served as the staff director and chief counsel for Senator Levin on the U.S. Senate Permanent Subcommittee on Investigations. She was also recently named for the second consecutive year to the Global Tax 50, an international list of 50 people and organizations who have influenced tax policy. Thank you, Elise. And I introduce you, Elise Bean, following me.
Well, we're lucky today to have such a distinguished and diverse panel, and I want to introduce our panelists for you. As you heard, former Senators Carl Levin and Tom Coburn worked together on the Permanent Subcommittee on Investigations. They did tax investigations together. They've also individually introduced legislation in the area of corporate tax, and we are very happy to have them with us here today. Robert Stack headed up President Obama's international tax policy for the last 4 years as Treasury Deputy Assistant Secretary for International Tax Affairs. Paul Osterhuis we're very proud to have him with us. He's a leading corporate tax advisor at Skadden Arps. He has advised many iconic American companies, and he knows these issues cold. He's going to give us some terrific insights, especially on the issue of corporate inversions. Ed Kleinbard is a former staff director for the Congressional Joint Committee on Tax. He's currently a professor at the University of Southern California, and he's the author of a new book, We're Better Than This, a book on government spending and tax policy. So before starting the conversation among our panelists, I'm going to take about 10 minutes to give you a little bit of background on corporate tax issues today. And after we go through that 10 minutes, then we'll start our conversation with the panelists. We hope near the end to have open up for questions from the audience. So I'd like to start so here we go. Next, I have a clicker. It's supposed to be me that's doing it. Okay. Ooh. Okay. First thing I want to point out is that corporate profits have been going up over the last, since 1950. Generally, they've been on an upswing. We had our financial crisis, that's the big dip, but generally we're doing all right. At the same time, the share of taxes being paid by corporations has gone down. Since 1950, you can see used to be, they would pay 1/3 of the tax burden in the United States. Now they're down to about 11%. So who else is paying the taxes as the corporations are paying less? Well, it's mostly individuals. They're now up to 80% of the tax burden through income tax and payroll tax. We also get some tax revenue from excise, estate, and other taxes, but corporate income tax is a pretty small slice. It's only 11%. So since the topic today are multinational corporations, those are corporations that have foreign earnings as well as U.S. earnings, and we want to talk about two major trends involving them. The first one is that increasingly they're declaring their offshore earnings in tax havens. Back in 1982, 23% of their profits were attributed to tax havens. That percentage is now doubled. It's about 55% right now. So it's over a majority of their profits are now being declared in tax havens, and these are just the 6 largest ones. Corporations were attributing those profits to those tax havens even when they had virtually no employees or operations in the tax haven. The second major trend we wanted to mention is that corporations are keeping an increasing share of their profits offshore. They're not bringing them back to the United States. This is a list of the top 30 corporations in the Fortune 500. You can see there are companies we've all heard of: Apple, GE, Microsoft, Pfizer, IBM, many others. Apple has by far the most money offshore. It was $180 billion in 2015. It's about $200 billion now. Altogether, the estimate is that there's $2.5 trillion in corporate cash held offshore. One of the reasons for this is the issue of deferral. Corporations have a tax benefit that almost no other taxpayer has. They can choose when to pay taxes on a certain portion of their profits. So as long as they keep their offshore earnings offshore, they don't have to pay U.S. taxes. None of the rest of us can just decide when we're going to pay taxes. That's a big benefit that multinationals have. I should also mention that when we say that the money is offshore, a lot of times it's not offshore. What they do, the corporations tell their foreign bank, I want to keep my money in U.S. dollars because it keeps its value very well. That means the foreign bank opens up a correspondent account in a U.S. bank. They put their money in U.S. banks, and in fact, companies like Apple have over 90% of their offshore money right here at home. So when we say offshore, it's just how they're attributing it for tax purposes. So those are the big picture stats. I want to talk about 2 specific examples just to give you a sense of the issues going on and why this is such a controversial area and a matter of debate for today and why tax reform is such a big deal. The first example is Microsoft. This was an investigation done by Senators Levin and Coburn in 2012, and they conducted a review of Microsoft's offshore tax arrangements. And what they found is that Microsoft, to simplify, had set up a subsidiary in Puerto Rico. They then sold to their Puerto Rican subsidiary the right to sell Microsoft products in North and South America. Having sold that to their Puerto Rican subsidiary, they then leased back, this is Microsoft USA, the right to sell Microsoft products in the United States. The reason they did that is then they had to pay royalties to their Puerto Rican subsidiary. And when we looked in 2011, they were paying 47 cents of every $1 of U.S. sales to their Puerto Rican subsidiary. The consequences are they would then tell Uncle Sam, I don't have a lot of profits to pay taxes on in the United States because I've sent the money to Puerto Rico. I have these payments I have to make to Puerto Rico. In the meantime, they had negotiated a tax rate in Puerto Rico of about 2%. So that's what was going on here. Senators Levin and Cohen calculated that as a result, Microsoft had avoided paying about $4.5 billion in U.S. taxes over a 3-year period. The IRS is now reviewing Microsoft's activities to see whether they complied with the tax law. Our second example involves Apple. In 2013, Senator Coburn was elevated to ranking Republican of our full committee, and so John McCain took his place on the subcommittee, and so this was an investigation that Senators Levin and McCain conducted on a bipartisan basis of Apple's offshore tax arrangements. What they found is that 30 years earlier, in the 1980s, Apple had established 3 subsidiaries in Ireland. Apple Operations International owned Apple Operations Europe, which owned Apple's Sales International. Apple then used a difference between U.S. and Irish law to decide that all 3 subsidiaries had no tax residency anywhere. The way it worked was this. In Irish law, it says we will tax an Irish corporation if it's managed and controlled in Ireland. These three companies at the time had no employees or offices in Ireland. They were managed and controlled, and still are today, in the United States. Meanwhile, under U.S. law, we tax corporations that are formed here. If they're formed somewhere else, like in Ireland, we say, all right, they're not a tax resident of the United States. Apple determined since they were neither a tax resident of Ireland or the United States, they were not a tax resident anywhere. And what we found is when we looked at a 3-year period from 2009 to 2012, Apple had directed $74 billion in non-U.S. sales to its Irish subsidiaries and paid virtually no tax, less than 2%. When the European Commission checked in 2014, the latest year for which we have statistics, Apple had paid a tax rate of 0.05%. Not zero completely, but pretty darn close. In 2016, the European Commission decided that Ireland had acted improperly, that they gave illegal state aid to Apple by giving it such a low tax rate. It disadvantaged its competitors. They labeled it illegal state aid, and they ordered Ireland to collect from Apple their statutory corporate tax rate of 12.5% over all that period. Turned out to be $14 billion. Apple and Ireland are appealing that decision. The U.S. Treasury has also objected to the reasoning. So those are a couple of examples. There are a lot more, but I only want to take 10 minutes. The result is that the United States is losing over $100 billion a year in revenue to corporations that are keeping their profits offshore. In 2013, the estimated total was $111 billion. If you extrapolate that over 10 years, it would be $1.1 trillion in lost corporate tax revenue from many of the most profitable corporations in the United States. So that's kind of where we are today and why there's a lot of talk about reforming our tax system. So here's some of the ideas. I just put some of them up there, but I ran out of space on the chart up there. But they include a lower corporate tax rate domestically in the United States. There are discussions about what tax rate should apply to foreign earnings. Territoriality system would mean a zero tax rate on foreign earnings. Some people say we should have a minimum, a worldwide rate. Other people say the rate should be equal between domestic and foreign earnings. We have the proposal about border adjustments, which we're going to talk about today. There are proposals to end deferral or modify it, close corporate offshore loopholes in the Apple and Microsoft situations. They used a lot of loopholes that some people say should be closed. There's the whole issue of repatriating those offshore funds. And then there's what do we do with those repatriated funds? Do we use them for infrastructure or for financing the lower corporate tax rates? Finally, there's a whole issue about whether we should repeal rules that would clamp down on corporate inversions and earnings stripping. So that's the overall picture I wanted to give you to start. And what we're going to do now is we're going to go to each of our panelists, and they're going to take about 5 minutes to make some opening remarks, and then we'll begin with questions.
Thanks for all the effort you made to organize this forum here today and all the work you've done over the years. I want to thank Tom Coburn for co-hosting this forum, for his great friendship over the years when we were in the Senate together. We were talking about whether we missed the Senate, and I won't use any of my 5 minutes to talk about that, but we go back a ways and we enjoy each other's company. Now the focus of today's forum, I want to thank our other panelists as well, and the Pew Center for the facility. The focus of today's forum was the subject of maybe a dozen hearings that we had at the Permanent Subcommittee on Investigations at the Senate. This was a fairly common subject of our work, bipartisan investigations, reports. I happen to believe that most of the deductions and credits that are in our tax code can be justified. You can argue an economic justification for most of the deductions and credits in our tax code. You might not agree with a particular justification. You may not agree that it's adequate to support favorable tax treatment, but at least there is an economic justification for most deductions. For instance, the oil and gas credits, I don't happen to support them, but there's an economic justification for them. It's an incentive to go look for energy. You may not agree that the corporations ought to be able to make charitable deductions, but at least there's a purpose, and that is to give an incentive to help charities. But there's some circumstances, there's some parts of our tax laws which have no economic justification, at least that I've heard. And the loopholes that we looked at the permanent subcommittee were the ones that had no apparent justification. And of course, the one that we spent most of our time on was the question of tax havens, where revenue is shifted to these offshore jurisdictions. And then when we press the companies that are using them, well, what's the economic justification for it? Are you closer to materials? Is there some kind of an advantage, a comparative advantage on labor? Are you closer to market? The answer we get almost invariably on this issue is, well, it's lawful. If you don't like the law, change it. Now, the result has been what Elise has just described. 30 of our largest, most profitable corporations with $160 billion of combined income in a recent 3-year period paid zero income taxes. 3/4 of the Fortune 500 corporations have created paper corporations in tax havens. Excuse me. And most of them have no employees there. And 365 of those top 500 corporations have together created about 10,000 of those shell corporations. That's about 300 paper corporations each on the average. So as a result, there's been a reduction in corporate contribution to our tax revenues. Trillions of dollars sit overseas. As Elise has mentioned, not truly overseas, but nonetheless treated as being overseas, not bringing home those profits that are now resting untaxed overseas, even though the intellectual property was created usually in the United States, supported by tax credits in the United States, and a patent law which which protects the creativity which produced that intellectual property. Now, there's a number of fictions which are used to produce this situation, and I've got written remarks, and I'm not going to go into the fictions in any detail to try to stick to 5 minutes, but copies of those remarks will be available in case any of you are interested in some of the detail of the fictions which are used in order to have the situation where tax havens can be used to avoid paying taxes. The first fiction probably is that the negotiations to set the value of the intellectual property that's transferred from a parent corporation in the U.S. to a foreign subsidiary, that those negotiations are arm's length. That is a fiction, and there's a number of other fictions which are used, which again I set forth in these printed remarks. But there is substantial support for another tax holiday to allow companies with a lot of money overseas to get a reduction in the tax rate in order to bring the money home. We had one before. I won't go into the detail as to how it worked, but nonetheless, there is substantial support for another tax holiday. Some of that support comes from those who feel that this is a good source for infrastructure money. And it's a bipartisan support, I think, for additional infrastructure spending. So I'm going to suggest here that there be a 3-part package deal. Part 1 would be a reduced rate for repatriating some of those $2 trillion. That's part 1, or a tax holiday. Part two, Congress link the billions of dollars that would result in tax collections to infrastructure. Part three, and for me this is probably the most important part of the package, the one which to me is absolutely critical, and that is that Congress close the tax loopholes that led and do lead the existing tax haven drain on our Treasury. In other words, if we're going to do this again, it's got to be the last time. We can't let this happen again. And to do that, it means you're going to have to close some of the loopholes which have allowed this to happen, including ending the use of check the box for this purpose. And again, I'm not going to be able to go into the details of which loopholes you'll need to close in order to end this tax haven abuse. They're laid out in the same paper which will be available to you. But this, to me, this package, which includes a rate reduction, allowing companies to repatriate funds, this package must include, finally, ending the loopholes so we don't see a repeat of the same situation that we're in now. And I'm going to close with a little bit of history. Back in 1961, a new president, John Kennedy, gave, I think, his first speech to the Congress. It was about taxes. And what he said was this. He said recently, this is 1961, recently more and more enterprises organized abroad by American firms have arranged their corporate structures aided by artificial arrangements between parent and subsidiary regarding intercompany pricing, the transfer of patent licensing rights, and similar practices which maximize the accumulation of profits in the tax haven. And he concluded, I recommend elimination of the tax haven abuse. That's President Kennedy, 1961. Congress acted. 2 years later, they adopted Subpart F. Subpart F has been subverted by the tax loopholes in various ways, again, which if you're interested, many of you know a lot more about this than I ever will, but for those of you that are really intrigued, you can read about it in a copy of the remarks that I'm making. And so there's going to be a very complex debate coming up about comprehensive tax reform. Whether or not that debate will lead to comprehensive tax reform is in doubt. It's extremely complex. There's a lot of interest on all sides of the issue. But it seems to me that we cannot wait. There's no justification for waiting to try to get to a comprehensive tax reform in the corporate area. We ought to eliminate these loopholes now because they're not justified. There's no justification for them. Yet when you come to tax reform, you're going to get people arguing justification for just about everything. But there is no justification for allowing these tax avoidance operations to continue in tax havens. There's no economic justification. It's just tax avoidance. So I hope we can act in that way. And again, I'd be happy to talk about what the elements of a package would be. But I do think that because of the broad support for repatriation, that we ought to say, yes, we'll try it again and make sure that we're not in this situation ever again by ending these tax haven loopholes. Again, thank you all for coming.
First of all, I'd like to thank the Levin Center for having me here today. As a person out of work, it's nice to have a reason to get out of bed and put a suit on.
Come back from Barbados.
I would also just point out to Senator Levin and Senators Coburn that the work you did in the permanent subcommittee on investigations certainly provided me with a fair amount to do over the last 4 years, occupied my time. It's no exaggeration to say that work really did set the basis and the underpinning for the BEPS work and a lot of what happened internationally in focusing on questions around multinational tax avoidance. I'd also like to begin by giving a shout out to all the Treasury and IRS, my former colleagues who are here in the room today. I want to assure everyone that the political folks are gone from these institutions, but the people in the room that you see are the backbone for those institutions. They're smart, they're capable, they're professional, and they're going to guide the new administration in that way as we move forward, and we can all have a lot of confidence that they are the best that we can find at the work that they do. I thought in my 5 minutes, I just wanted to do a little bit of a table setting as we move into this tax reform era, right? The two things that like the inside folks know on the Hill and all are, and the tax policy folks, are we're going to be looking at two kinds of issues. One question is going to be kind of, and the economist taught me some of this while I was in government, one question is going to be, does the tax raise revenue? Does it raise the revenue we need to do what we need to do to provide the services to the country? It's a real inside baseball question, but it's a big question. And it's going to put a lot of pressure on the professional economists at JCT and in Treasury to help the new administration and the Congress kind of sort through what we can do in the area of tax reform generally and corporate tax reform more narrowly. The second issue, about which I'm not an expert, but it's a big deal, is the distributional effects of our tax changes. Coming out of the type of election we just came out of, I think people will be focused sharply on, in a time of restricted resources, who's getting the benefit of whichever tax cuts or tax practices are going, to which strata of the income groups does it go. So those to me are like two big issues. And I want to go to the revenue side first, because I want to get folks focused on something. If you look at Obama and Camp, I think there were a couple of givens in tax reform debate until more recently, right? And it consisted of three parts. First was we would lower the rate, so there's universal agreement that we should lower the tax rate. Second, we should broaden the base. And third, we'd need to do something to stop the kind of profit shifting that Senator Levin talked about. Related to that, though, was an intense focus on the revenue that was going to need to be earned through the corporate tax. And in that particular debate, I just wanted to point out that the President Obama's plan got to a 28% corporate rate, a 19% min tax, and a 14% repatriation rate. And Congressman Camp in his plan got to about a 25% doing revenue neutral corporate tax reform. And I just throw those out there not as the ideas that will necessarily carry forward, but in both of those plans, we had economists looking at the revenue that could be raised to try to do something called revenue neutral in the corporate tax space, and those were the numbers they came up with. So as you see new plans floating and you see new numbers, we all have to be asking ourselves, does it work for the country? Does it get us the revenue that we need to do the things we need to do? And I think those are kind of interesting baselines from which to work off. I would note, by the way, that a subtext point, and it's a little weedy, but it's worth focusing on, because of the repatriation. If you're able to balance the books in 10 years, but doing it by taking a huge chunk of the tax that comes from the repatriation, we all have to ask ourselves, what does that do in the out years? And is it fair to the future generations to basically kind of cook the books and say, yeah, we did something revenue neutral, but there's a long-term loser in that corporate tax effect that Elise so clearly pointed out. And I think those are questions that as citizens we all have to be looking at. Now, one of the things that I learned in my job, where I really did spend a lot of time out of the country dealing with other countries and tax, is the current international tax system, with respect to corporations, is focused largely on what we've all come to call the supernormal returns. In other words, nobody's really fighting over the normal returns a business might expect to get from normal investments, but the real prize in this space is the supernormal income that can be earned through the intellectual property and all the companies that we know and we hear about all the time. And that is where the focus is. However, I also learned that there's enormous pressure on the way the international rules are written today. And the pressure comes in three places. And it relates directly to these supernormal returns that the senator was really referring to, a lot of which is in the tax havens, right? So capital is mobile. You can stick it anywhere, even in a company that you can fight about, is it a paper company or not? And certainly the ownership of intellectual property has this mobile feature. And finally, as we've learned through the inversion debate, the residency of companies is very fragile because it's not that hard to be a resident of Switzerland as opposed to the United States at the top tier company. And yet those things are very, very important to making a global tax system work. Sorry about that.
We all looked in our pockets. We all wondered.
That was Microsoft.
I should have said, please, turn off your phones right now.
So that tension, right, that weakness about the current international system and the focus on residency and mobility of capital and intellectual property led to a separate way to think about these issues, which leads you to the destination-based cash flow tax, which we'll talk about today. Because what that is trying to do is take the pressure off these very fragile foundations of the international system and look at a different way of approaching the question. And I'm sure we'll talk more about it later. However, the supernatural return search has also affected governments all over the world. And it isn't just the Indias and the Chinas, but it's the Australias and the criminal cases in Italy and France, where the countries themselves are very focused on finding where those normal returns are. Maybe they are supernatural. and grabbing them into their jurisdictions. And then my final point is as we do tax reform in the United States, will we be looking to build some more stability and certainty into the global system so that the tax havens really simply dry out of the equation because there's no benefit in using them? And are companies willing to look at global structures that reduce that uncertainty and really instability from things like aggressive audits, laws every day that are trying to grab back income from tax havens, and state aid investigations? So I just leave us with that question: is what will, at the end of the day, our tax reform look like if we're trying to promote stability and certainty in the global tax system? So that's just my heading up of the issues.
Mr. Osterheis.
I appreciate Elisa's comments on the amount of income that is offshore, and I'm obviously I've had a part of that with many of our clients. And if we were in a world where only U.S. companies were on the landscape, or even a world like in the early 60s where U.S. multinationals predominated, then the perspective of seeing the income from outside the United States as rightly being ours would be a fair one. But that's not our world today. When you think about some of the companies that Elise mentioned and other multinationals, their main competitors are not necessarily other U.S. companies, and they're certainly not local companies. They're multinationals. Apple's main competitor is Samsung. My client HP Inc.'s leading competitor is Lenovo. Pfizer has to compete against Novartis and Glaxo. P&G competes against Unilever. You could go on. Mars competes against Nestle. These are multinationals from different countries. And of course, the problem is if we substantially increase the taxation of offshore earnings of U.S. multinationals, how do we then do the same with the foreign multinationals? And the answer is we can't in an income tax system. And so that is what creates an unlevel playing field. We don't call it competitiveness anymore. We call it an unlevel playing field because that's really a more accurate description. U.S. companies can compete notwithstanding it, but it does long-run damage and to our competitive position, and that is part of why the inversion movement got its start. But that said, I don't disagree that the current system is broken and that we should not have a system which is called deferral, always, to my mind, a misnomer, a system where the earnings of foreign corporations that are controlled by U.S. companies are taxed when the earnings come back, but not until they come back. We should have a system that either exempts them or taxes them currently, or some of both, because it is purely dysfunctional to have those earnings stay offshore. And yes, they are in U.S. dollars, and we should all be glad that they're in U.S. dollars, but they're not being efficiently used. Those earnings could be much more efficiently used if they were either distributed out to shareholders or used to make investments in the United States, and not, as it is today, with a bias towards looking for ways to use them offshore. In other words, buy things outside the United States and pay people like me to help figure out ways to more effectively utilize those earnings. There's a lot of friction in the system that results from that. So coming up with a way to revise the taxation of U.S. multinationals that allows them to move their earnings back and goes in the direction of leveling the playing field with foreign multinationals seems to me to be two important goals. And they're not necessarily inconsistent. I don't think that the approach, I disagree with Bob, that the approach of the Obama administration, which puts a tax on multinationals at 19%, that still leaves the playing field very unlevel, and compensates for that by expanding the inversion rules so that you're effectively building walls around U.S. multinationals. I think what that really does is it means over the long run you'll find more and more international assets that are held by foreign multinationals rather than U.S. multinationals. And I think if we're going down that road, we need to face up to that. I mean, we're talking about rules that will be around for 20, 30 years. And over that time, a lot can happen. And a lot of my practice is in M&A, and when you run the models, if somebody's selling a business, you can figure out how it's more valuable in the hands of foreign owners than of U.S. owners. And the question is, how much do we care about that? For my sake, I think we should care about it a lot. As Bob said, that's part of the motivation for the destination-based tax proposal in the House blueprint. It gets rid of transfer pricing, it levels the playing field between foreign multinationals and U.S. multinationals. Obviously, it raises a lot of other concerns that are perfectly legitimate, but it does do that, and that's one reason why I think pretty soon you're going to see a number of U.S. multinationals standing up and supporting that kind of direction to move in for tax policy. Even though under some of those proposals, like the blueprint, it's actually going to raise their taxes. But when I talk to senior executives in companies, they say that's not the principal concern. The principal concern is leveling the playing field so that if I'm Pfizer, I can compete with Novartis without my hands tied behind my back.
Mr. Kleinberg.
In keeping with my past practice, I'm going to disagree with everybody about everything.
That's why you're here.
And starting even with poor Elise, who misstated the title of my book on fiscal policy for the 21st century. She told you that the book was We Are Better Than This. That is not correct. The book's title is We Are Better Than This. And it turns out to have been oddly prescient. So we know a lot about the infirmities of the current tax system. We have a higher headline tax rate than do those of our peer countries. That has its own distortive effects. It also violates my Gazelle rule, which says that in tax policy matters, countries ought to situate themselves as one of the pack of gazelles, neither the first nor the last, because those are the ones that are most likely to get gobbled up by the lions of tax avoidance. We have widely different tax rates for different investments and for different forms of financing. We have today negative marginal tax rates on leveraged investment in equipment, which in effect means that the after-tax rate of return on those investments is higher than the pre-tax rate of return, which is a very odd way to run a tax system. And the current tax system aids and abets international tax avoidance, not just of the U.S. tax base, but of that of other high-tax countries as well. This has been the point of all of my stateless income papers over the years. It is also, I think, the point of the work of the Permanent Subcommittee on Investigations. It is not contradicted by the situation of poor Pfizer, which has a 7% cash tax rate around the world. I would submit to you that Pfizer ought to be able to muddle through its business with that tax rate. And it leads to unstable capital structures within multinationals because they keep cash outside the United States and borrow in the United States, thereby further eroding the US base. The destination-based cash flow tax that is under consideration by the House, under the name of the House Blueprint, is a response. It has two parts, and it's important to keep those separate in our talk. The cash flow part and the destination basis part. The cash flow part is aimed at the questions of the efficiency of the tax directly. It leads to a constant tax rate on marginal investments, regardless of the investment. It leads to a constant tax rate regardless of the form of financing the investment. And in doing so, and I've always wondered exactly how Republican leadership in the House is reconciled to this fact, it raises the effective tax rate on leveraged marginal investments from negative tax rates all the way up to zero, which is a tax increase. The destination-based part, as Paul said, is aimed precisely at the stateless income problems that we've all mentioned already. It largely eliminates those kinds of games, and therefore, given that I've been very concerned about those issues for many years now, what's not to like about the destination-based cash flow tax? There's a lot to discuss, but let me just make a couple of quick points. The first is that its economic effect depends entirely on what I call the FX magic, on currency exchange rate adjusting as theory predicts. I'm willing to accept the theory is accurate here, but if that's true, that has all sorts of interesting knock-on effects and actually puts us between a rock and a hard place. If the FX magic does not happen, then Joe Consumer faces higher prices at Walmart's. If it does happen, Joe Consumer does not face higher prices at Walmart's, and every investor in the United States, collectively, all of us, whether we're multinationals or little Eddie with his stock portfolio here, loses what in the aggregate is trillions of dollars of wealth by virtue of the US dollar appreciating so dramatically that all investments in foreign securities go down in value. It is a tax that is like a Rorschach test, is easily susceptible to 1,000 different interpretations, which leads to widespread misunderstandings as to its application. It is a subtle tax, as Paul Krugman identified the other day. And very interestingly, and here Paul has been instrumental in helping a group centered around the Oxford Center of Business Taxation in developing these ideas, and Paul's to be commended for his work on that. As their recent monograph from a couple of days ago makes clear, it places the United States as the world's newest, largest, and most efficient tax haven if the United States adopts this unilateral. And the Oxford monograph is very candid about the problems of one country and only one country adopting this system. We essentially turn the United States into a tax haven. Fortunately, it turns out that you can have your cake and eat it too in this area. The cash flow or cash flow equivalent tax ideas, I think, are worth pursuing, but it is not necessary to go to the destination basis to solve the problems of stateless income planning. The alternative can be called a super origin basis, a worldwide consolidation basis for taxing U.S. companies. It is not difficult to define who is a U.S. company. Talk about that in a new paper, The Right to Tax at the Right Time. But if you have a cash flow or cash flow equivalent tax so that the normal returns to investment are not being taxed under the cash flow tax, and you adopt worldwide consolidation, and you adopt a moderate tax rate in the order of magnitude of 25%, you have a very attractive environment from which U.S. multinationals can carry out their big business around the world. Finally, we need to remember, in talking about the United States versus other countries and U.S. firms versus foreign firms, that the United States is the bell cow here. The United States is going to lead the way in what is acceptable by way of international tax gaming. And as long as the United States aids and abets its multinationals in their stateless income planning, it is not realistic to expect any other country to tighten their rules.
I think some ground rules, or at least axioms for me, are the following. Capital formation ultimately creates wealth. So a tax system that impacts that will impact the creation of wealth, whether here or somewhere else. The second axiom is greed conquers all technologic difficulty. And if you don't believe that, look at our present tax code. The fact is you will see manipulation of any tax code we have because it benefits somebody to manipulate it. Whether they manipulate it in the filings or manipulate it through lobbyists to get a loophole, the fact is, and as a physician, I'm trained to solve the disease, not the symptoms. And I think it's really easy to look at symptoms in terms of our corporate tax code and not look at what the disease is. And as a selfish American, I want capital invested here that causes wealth to be created here. And I think we ought to have a tax system that enhances that and also recognizes the second axiom of greed. And so I look forward to our discussion today. I heard a couple of comments as we went through here in terms of the revenue we need. But nobody ever talks about the expenses that we shouldn't be making. And the $400 billion that's out there that's either fraud, waste, or duplication every year, fully documented by the Government Accountability Office. So we sit here and say, for example, Senator Levin's idea on our infrastructure. I don't have any problem with that, but I certainly would think we ought to get rid of $100 billion worth of duplication before we do that, before we tax American corporations while we're still wasting $400 billion. So look forward to our discussion. The misdirection of capital that we have today is horrendous. And in the long run, it hurts the millennial generation, who, by the way, on a 75-year basis, owe $1,760,000 each, with a negative net worth that's minus $7,000 right now. So good luck, millennials. And the way to change that is to have more investment in this country, more wealth created, and more tax revenue created. Thank you.
The first question I want to ask about is, since we're concentrating today on multinational corporations, is the proper tax rate for foreign earnings. Now, some want a territorial system, which essentially means a zero tax rate on foreign earnings. President Obama advocated a minimum worldwide corporate tax rate, but one that was lower than the domestic rate. A third group says that we should have tax rates that are the same for offshore earnings and for domestic earnings, so you don't create an incentive to go offshore. And a fourth group even says sometimes, why isn't the tax rate on foreign earnings higher than on domestic earnings so that we encourage domestic investment? So there are lots of ways to go about this, and what I want to do is get the thoughts of our panelists. And Mr. Stack, I'm going to put you on the spot to get us started.
Going back to the Obama plan, the 19% on that, one of the points I was trying to make about the Obama plan was not to say it was the gold standard, but to say that those numbers were what was needed to get to revenue neutrality, just as a baseline for all of our discussions, and we need to think about those issues as we move forward. I actually think there's a little bit of a false choice. I think you saw that both the Camp and Obama were kind of moving together in a sense of offshore income that was not being taxed at some, let's say, was being taxed at a low enough rate that one had suspicion that there could be tax engineering, was going to kind of wind its way into the United States. And then the rate you use is simply a function of what you need, to hit your revenue targets. I guess the way I want to answer the question is this way. pure territoriality, I think, is a bit of uh, a false goal for U.S. multinationals, because I think it leaves them and the rest of the tax haven problem around the world there to be exploited. And I think that's basically a false choice for U.S. multinationals, who at the same time are concerned about aggressive audits, law after law in different countries trying to peel back income, from tax havens, et cetera. So something like a quasi-territorial that would build some stability into the system makes sense. Let me make an observation that I made often at the OECD, which was, if you look around the world at the number of countries that are putting in taxes that say, oh, if your royalty goes off to a country where the tax rate is less than X, we're going to put a withholding tax, or you can't deduct it. Or the British DPT or the Australian DPT, which are really looking at, well, where does that income go and does it get taxed somewhere? If not, we're going to grab it back into Australia. And I think that if the US multinational community doesn't try to get behind a system that stops that, which is really a backdoor minimum tax that the other countries are going to impose on us if we don't come up with something stabilizing. So I just think there needs to be something done to take the havens out of the picture. Otherwise, U.S. multinationals are in for a long, hard slog.
The OECD process was interesting to me in several respects, and I'd be interested if Bob sees it differently. But one respect was that other foreign countries evidenced little interest in coming up with agreed upon CFC rules for taxing foreign subsidiaries of local multinationals that would have the kind of minimum tax approach or camp excess profits approach that has been talked about in the United States. And so we're not going to get, I think it's pretty clear, we're not in any time soon going to get any kind of multinational consensus on how to more evenly, if you will, tax the foreign earnings of multinationals. So whatever the U.S. does, it's doing unilaterally to its multinationals. And to my mind, in thinking about that, the first question in terms of what rate is, well, what's the rate on domestic earnings? Because if the rate on domestic earnings stays at 35%, then it's very hard to come up with a rate on foreign earnings that's either not punitive to U.S. multinationals or leads to still a big enough gap that the incentives are going to be similar to what they are today. And so, to my mind, if we are sticking with a rate that is close to 35%, maybe even 28%, we need to start thinking about alternatives to transfer pricing, which is obviously major surgery and pretty disruptive. But it seems to me folks who want rates that high need to be thinking about that. If we can get the corporate rate substantially lower, then then whether we go to pure territorial or not, I think can become a lot smaller issue, and something that could be discussed. But once it's a smaller issue, then maybe going to pure territorial isn't that bad a move for the United States. In any case, I think the other thing to keep in mind is we don't want to be fighting the old wars. We want to be looking to the future. And one of the things that I think the hearings that Senator Levin had, the OECD work, and obviously the EU state aid work is doing is changing the ability of multinationals, not just U.S. multinationals, but the other multinationals from other countries who also use tax havens, changing their ability to conveniently use tax havens. I mean, Luxembourg is kind of falling apart these days in terms of a place for financial activity and maybe not so much economic activity. Singapore, who's very smart about all of this, is negotiating a lot harder now because they know the bar is going up. The rates are going up in other countries. And so the phenomenon of a stateless income is, I think, substantially diminishing. And if you look 3 years down the road, I think you will find that good tax planners might be able to get a 10 or a 12% effective rate, but not a 0 or 2% effective rate as they've been able to do. I mean, Ireland, a lot of the stateless income came from the fact that jurisdictions which were trying to encourage real activity like manufacturing activity even though they had statutory rates that were reasonably high, that were at least double digit, were willing to allow multinationals to engage in planning to reduce those rates. And that's what the state aid has gone after. Whether that's a proper way to do it or not is highly debatable in terms of the past. But for the future, changing the ground rules so that if you're in Ireland, you have to pay something close to a 12% rate, and if you're in Singapore, or if you're in Luxembourg, if they don't change the rate, you have to pay a 25% rate. We're coming to a place where that is much more of a reality than it was 2 or 3 or 5 years ago.
I agree with everything that Paul has said in the sense that first, the 35% rate violates the gazelle theory, even if there were no other efficiency issues associated with it. 25% and cash flow equivalent is by itself a double benefit to U.S. firms because the cash flow base is smaller than an income tax base. And it is for that reason and that reason alone that I can advocate a worldwide tax consolidation, which also completely eliminates all the games of stateless income planning without the same side effects on trillions of dollars of wealth loss that are attendant on the destination-based cash flow tax. So the countries where you're actually doing business have first dibs on the income. And therefore, it's not really fair to set this up as territorial means zero tax. In an ideal world, territorial means you pay tax where you're really doing business. Transfer pricing is supposed to make that happen. I think we're all deeply skeptical of transfer pricing's ability to deliver that in light of the problem Dr. Coburn observed of the universality of human greed and ingenuity, and therefore you need a more stable solution. The destination-based cash flow tax does do that in respect of international business operations. It has lots of other knock-on effects that deserve more attention, but we need to get to a stabler solution than one that relies on transfer pricing to define what is income attributable to each jurisdiction around the world.
If in fact everybody had a true territorial base and everybody had very similar tax rates, you'd see capital not misdirected, which is my whole goal. And what, besides having a revenue neutral stream of income, what we ought to have is something that we don't have to keep going back and fixing. So go back to what Carl Levin said, no matter what we do, if you don't fix the loopholes that are there today with any corporate tax reform, we'll be right back here in 4 or 5 years because of the first principle I've managed. And they'll figure it out. You know, when my 2-year-old grandson can figure stuff out on a computer that I can't figure out, I know they'll figure it out. So I think it's important for us to recognize, again, as you described, Ed, fix the real problem, not the symptom of the problem. And you know, whether it's a cash flow accounting tax or it's a true territorial tax that with fairly even rates. The thing that bothers me is, you know, if we get in a worldwide competition on true tax rates, with our debt load and unfunded liability load, we're going to lose, which means our revenues are going to go down, not up. And so I think it's really prudent for us to be addressing these issues now because the economic situation that the government's going to find itself is worsening every year. And if you look at CBO, we're talking $1 trillion deficits for the next 10, 15 years, which is going to be really hard to manage as interest rates.
Just the verse says that nobody's talking about the other half of the picture, which is the spending side and the waste. He has surely focused a lot on that issue, and I commend him for it. But getting back to the revenue side, I think that the issue is going to, in terms of what's your rate on foreign earnings, is going to depend on how you define foreign earnings. Right now, foreign earnings includes things which are not truly earned overseas. There's profits and revenues which are transferred to yourself overseas, where there's no economic activity taking place. It's just intellectual property transferred to yourself, and then the money which comes in, the interest which is paid, or the dividends which are paid to that controlled foreign corporation are magically transferred into active deferred income through this check the box and other mechanism. And so I have to agree with Dr. Coburn on the fact you want to go after the disease and not the symptoms. What I'm saying is it's going to take a long time. I believe it's very important to do it. The dream of a worldwide tax system is great. It's going to take a long time before we can figure out our own tax system so we're not disadvantaged. What do you do in the meantime? You got this big elephant in the room. It's called repatriation. And for me, the question is whether or not you're going to allow repatriation for any purpose if you prevent it from happening again. And that, to me, is the immediate issue. And it's going to come up quick. This repatriation thing is being driven in part by the demand for money for infrastructure. So that's the part I think we ought to focus on. And that goes to the question really of how do you define revenues? Do you lump together active and passive revenues as revenues and then decide if you're going to go to a territorial system, we would count all of those as revenues with a territorial tax? My gosh, you're not going to be collecting many taxes.
The issue of repatriation is very important. But I want to get on the table that I at least feel quite strongly that a repatriation holiday, whatever its terms, whatever its uses, is a fundamentally bad idea. Because repatriation, part deux, leads to repatriation, it's international, so we have to talk in French, leads to repatriation, part trois, and so on. It just encourages firms to double down on all of the gaming that they're doing. We have to get to the place that Senator Levin wants to get to, but the only way to do that doesn't lead to still more stateless income planning is a mandatory arrangement as part of tax reform. And in that respect, I think this may help drive tax reform because of the interest in getting that cash fully back into the hands of U.S. shareholders. But a standalone holiday, whatever its terms, has an awful lot of dangerous side effects.
So we've talked about this $2.5 trillion offshore, and one proposal is to require or to encourage repatriation by having a lower tax rate. But others say, when they incurred those profits, they knew what the tax rate was. We should impose the entire 35%. So that's one of the issues is what tax rate. Other people are talking about, 14% or 8.75%, or the rate that we used in 2004 was 5.25%. So that's one of the issues is what rate you're going to use. And a related debate is what are you going to use those funds for? We've talked about repatriation for infrastructure. A different idea is to use it to finance the lower corporate rates. And as Mr. Stack pointed out, that's sort of a one-time hit. What do you do after that? And so I want to ask the whole panel, there are a whole range of repatriation issues I'd like everybody to have a chance to comment on.
I agree with Ed's comment that having a repatriation-only proposal, even a mandatory one, isn't going to solve problems for anybody. And it's also, I would be interested in the revenue estimators in the crowd here, but I don't think it raises that much money because money is fungible. If you can bring back your old earnings cheap, then you can leave more new earnings offshore, and the revenue estimators know that. And so you start out in a hole in terms of losing revenue with a mandatory repat, and you have to get the rate high enough on the repat to get out of that hole and then start raising money for whatever you want. So that's not a very efficient way to do it. A better way to do it is in the context of a broader reform proposal that eliminates deferral, either by instituting territorial or by having the sort of minimum tax or hybrid approach that Chairman Camp and President Obama proposed. In that context, then what kind of rate do you have? I mean, I've been practicing tax law for over 30 years, and I know the term deferral is something that is in the political lexicon and has become part of our language. But you really don't think of it that way when you have a multinational operation that is making real investments in foreign countries. Because after all, if you're going to be, particularly if you're a technology company, a pharma company, leveraging off your intellectual property, you need to be there everywhere in the world to leverage off what you have, and you need to make investments, and those are permanent investments that you're making to a great extent. I mean, you look at some of our more traditional multinationals like General Electric and IBM, and Johnson & Johnson, they have huge investments in their worldwide operations that are real investments, not just U.S. Treasuries that they're buying, and so taxing that at a very high rate seems to me to be inconsistent with where we ought to be going as a way to try to get out of the situation we're in and into more of a territorial system. The House bill does it at 3.5%. I think that's pretty reasonable. And then the question is, what do you do with funds that are more liquid? And the House bill does that at, 8.75%, I believe, which is 25% of the 35% rate. That's probably pretty reasonable for those earnings too. But just to be sure, that's not the full 2.5 trillion. From what I understand, the revenue estimators say it's a little less than half of that is in more liquid form, and the other half is in more bricks and mortar type investments, or R&D investments, or whatever investments companies have made outside the United States with their earnings.
I see repatriation as treating the symptom and not the disease. Repatriation with closing of tax loopholes, that's fixing disease. Modifying the whole corporate tax structure and eliminating the loopholes, that's treating. But just repatriating money back so we solve a short-term problem with infrastructure, I'm talking 10 years like CBO talks short-term, the fact is it just treats the symptom. It doesn't fix the disease. The disease is we have a tax code that is so easily manipulated and designed to be that way originally to give us an advantage. It was originally designed to give us an advantage, and now that it's disadvantageous to revenues to the federal government, one of the things is take some of the money back. But if you don't fix the problem as you take the money back, you're just treating the symptoms.
Could I just want to add, I think tax policy folks see the repatriation ideally as a bridge to a new system. So it's kind of a one-time clean up the house. I don't think there's any tax policy people who think voluntary makes any sense, or a one-time standalone makes any sense as a policy. I don't think there'll be any disagreement on that. I disagree with Paul on the different rates, the differentials, and really for two reasons. One, foreign earnings are foreign earnings. The economists taught me that because it's past activity, you can kind of tax it at any rate you want because it's not going to affect future economic decisions, number one. But number two, I don't understand in a very, very difficult political environment to do tax reform, we're going to create winners and losers between the people that might have their earnings in cash and the people that may have it in bricks and mortar. So just as a very practical matter, it's not intuitive to me why we would set that up as an additional political difficulty. In terms of the rate, I just view that also as a political question. In other words, you've got this stuff of all this tax reform that's going to be going on across all these different issues, and somebody's going to have to come up with a number that enough folks will buy off on, and it's not going to be 35 or 25. It's going to be something less, and then the question is, what's the best deal people can cut for the government in the course of doing the work? So I view that question as really a political question.
It's not just what's the number that everybody agrees on. What does it do for us in terms of competitive nature in the world, in terms of our tax code? It's about the future. It's not necessarily about the past.
Well, but this amount, the $2.5 trillion, does relate entirely to the past. It's the past earnings. The way to look at this, I think, is that it's a transition tax. It's a transition tax in moving to a better system. The reason to do that as a transition tax is that it does not encourage doubling down on gaming, first. And second, you can have a higher rate. If it's a voluntary tax in particular, you need to make the rate very low. And for the reasons Bob said, there's no reason have a low tax on past activity. Actually, I am, however, sympathetic to the split rate and for liquidity reasons, if for nothing else. The idea that bricks and mortar should get a lower rate. The house numbers are absurdly low. We need the eggs. We need the revenue. I believe that in the end, this is an extraordinarily convenient dial or knob that tax writers of the respective committees can turn when they discover that they're $112 billion short of their revenue estimate. They'll say, how much do we have to boost the repat tax to make up that $112 billion? It's a gift to the tax writing committees because it's a very convenient dial. Split rates where you end up with 8.5 and 17 make a lot more sense to me than 3.5 and 8. But whatever they are easily adjustable to drive whatever revenue numbers are required.
Just simply allowing repatriation at whatever lower rate is treating a symptom and not the disease. If you just do that. In fact, it's worse. If you just do that, you're maintaining the symptom. You're perpetuating the symptom. And so, unless it's combined with closing the loopholes which allow for that, it's doing harm. Not just for the policy reasons, by the way. Policymakers are right. Just a one-time repatriation isn't solving anything, really. It may, and by the way, I've been there. I know the temptation. There's a pot of money out there in repatriation. And it's going to be used. I believe it's going to be used. That's my point. But if it's just simply used, it not only violates good policy, it not only maintains symptoms, but it's worse. It will perpetuate a third round and a fourth round. And so here, you've got to close the loopholes which allow for the tax havens to be an advantage. That's not comprehensive tax reform. It may be a part of it, a big part of it. But the comprehensive tax reform is a much bigger picture than just simply the tax haven picture.
But the House Republican tax plan proposes eliminating the tax on exports and eliminating the deductions for imports. We've heard a little bit about it today, but I wanted to give all the panelists a chance to give us their thoughts about that, including the issue of we've never done it before, and what does it mean to have our entire corporate sector take on this new type of tax without any pilot project, without any, just going cold turkey. So I'd like to have the panelists offer their comments.
To my mind, I'm really glad that the House Republicans have put this proposal forward because it is worthy of everybody's consideration. Ed has talked about some of the advantages of it, and I agree with that in terms of a level playing field. And in terms of it being a cash flow tax that exempts a normal rate of return by taxing cash flows. There's a lot of concern about how dramatic a change it would be and how risky it is in terms of the dramatic nature of it, and that's true. I mean, the FX magic, as Ed says, I'm not sure it's magic. It seems to me it's basic supply and demand, but markets are sticky. Currencies are managed. Good luck in managing a currency if we were to actually have a 20% border adjustment. You'd soak up your reserves pretty quickly, I would think. But nonetheless, there could be a lot of rocky steps in the process. And it is absolutely right. For foreigners who own U.S. dollar assets, it would be a plus. And for my partners in London who get paid in dollars are backing this tax 100%. They live in a pound environment and get paid in dollars. But so there's a big wealth shift if you do it, and we have to think about all those things. But from my personal point of view, I mean, I've always been one who thought we would be a lot better off in this country if we had a value-added tax at a moderate rate and used it to reduce payroll taxes and reduce business taxes. And there's no reason why why the destination-based cash flow tax can't give you a framework to achieve something that is not that distant from that result. As Ed says, there are two pieces to it, the destination base and the cash flow base. And if we did a cash flow tax, I've had the pleasure of going through the Internal Revenue Code and looking at all the different things we could get rid of with a cash flow tax. Kind of scares my younger partners, to be honest, but because a lot of the things they would be dealing with in their careers would go away, but it would be a much simpler tax, and the economists will tell you it's a much more efficient tax for the reasons that Ed articulated. And in a time when we're all concerned about economic growth and productivity, moving to a cash flow tax seems to have a lot of benefits. Once you say that, then you don't have to make it either origin-based or destination-based. You can mix and match as you wish. In the monogram that Ed was referencing, the authors mentioned doing a partial border adjustment in a cash flow tax, and that's a way of having in effect if you will, a variant on a value-added tax that taxes consumption while still having a substantial tax on production, the origin-based portion of the tax. So the blueprint provides a framework for thinking about all of these issues, and particularly thinking about a cash flow tax, that I salute the House Republicans for having offered, and hopefully we'll continue that debate throughout the year.
Terribly important to keep the virtues of the cash flow part and the virtues and vices of the destination-based part separate in our discussions. A cash flow or cash flow equivalent tax is efficient. It is a more neutral environment. It gets rid of all of tax-free reorganizations. I could teach my corporate tax class in a week instead of 14 weeks, which I'm sure my students would appreciate. But the destination-based part has one very strong virtue, which is it gets rid of the gaming, international gaming, the stateless income type issues. It does not, in fact, really raise $1 trillion. Alan Viard has a good blog post today or yesterday on that subject. The $1 trillion is an artificial number triggered only by virtue of the 10-year budget window in a infinite horizon. In present value terms, it has zero revenue raising effect, but it has some very difficult side effects. I, for the life of me, don't understand why the discussion so far is simply put to one side the idea that Americans are going to lose trillions of dollars in wealth if the destination base works as planned. That is a necessary consequence of the FX magic. The cash flow part has the issues of how do you handle financial institutions and financial transactions. The Oxford monograph goes through that at a level of sophistication I at least couldn't understand on the airplane ride here yesterday. I urge you all to look at that monograph to understand what we're buying if we buy this, this idea. And to me, the Oxford monograph also is very articulate on the fact that if we go this alone, we are turning the United States into the problem. We are turning the United States into the tax haven for the world. So instead of closing loopholes, we're setting ourselves up as the new Luxembourg. And I find that to be a very troubling agenda for the United States.
What do you see in terms of currency manipulation or currency efforts by those if we were to have this? What would the currency response be?
I think the way I think of the question, though, is it seems clear that in the political atmosphere, the debate has gelled, where the proponents are saying the FX will take care of itself, and the retailers and importers saying, no, it won't. And so I just think of this, again, stepping back as it'll kind of play out in the politics. I do think Ed's point about if we become the tax haven overnight, remember I said earlier, everybody wants to tax those supernormal returns. And if the United States walks away, from exporters, what will be the reaction of the rest of the world? And finally, we haven't gotten into the weeds of the WTO issue, but again, what do those types of issues do for certainty and predictability going forward for businesses? But let me close. This is a serious proposal by serious people that's worthy of the kind of analysis and thought that people have talked about it here. And remember, it grew out of the fact that things like transfer pricing, residence, mobility are very, very tenuous and treacherous in the rest of the world, and customers are not. So there's I almost, when I did BEPS, I was very conscious of the fact that we were not given in a 2-year window the opportunity to reform the international tax system. We were very much given, fix the old clunker and maybe test the carburetor or something, and we did the best we could. But these are ideas that, in a good country, we should be talking about in the parameters of the discussion we're having today.
Ed's absolutely right that as a permanent matter, as an indefinite matter, it shouldn't raise revenue. But it no doubt would during a transition. And if we shift to a cash flow tax, as is Marty Sullivan here today, as Marty wrote, when you switch to a cash flow tax, you lose $1 trillion the first 10 years, you raise $1 trillion the second 10 years, because you've got to recognize depreciation deductions for old capital, and you probably have to recognize some interest deductions for old loans. And so the transition period is substantial, and the overlap between expensing and depreciation while you're still deducting interest on old loans can be pretty expensive. And the destination based revenue that's raised during that transition can help smooth your way to a cash flow tax that is more efficient in the long run and does raise substantial revenues. In fact, one of the interesting things about the House blueprint, if you look at the revenue estimates that have been done to date by private sectors for it, is that it doesn't have to sunset after 10 years if they were to do reconciliation in the Senate, because it probably will be projected to raise money in the second 10 years, even if it loses money in the first 10 years because of the transition.
I've seen the arguments for the cash flow tax, for a long time. There's a lot of benefit to it. But I also have heard that it's unachievable. As a practical matter, it's unachievable.
Well, we'll see.
I did say, Alan Auerbach and Michael Devereux are the academics who came up with a destination-based cash flow tax. Well, that's what they tell me.
Yeah, they refined it. I think it's fair. It goes back to David Bradford, as you know.
Well, no, he didn't have the destination-based part. David did not. But when this did come out, I called up Alan, and when the House blueprint came out, I called up Alan and said, "You are the dog that caught the bus." This is something that academics have chased for years, and now you've caught it and you own it, and it's quite a mouthful to see it actually implemented or not.
In the last year of the Obama presidency, the Treasury Department issued some regulations to clamp down on inversions and earnings stripping, both of which were being used by some U.S. corporations to essentially move their profits out of the United States and avoid U.S. corporate tax. Some are now calling on Congress to use the Congressional Review Act to repeal those rules and prohibit the Treasury Department from addressing either problem for the foreseeable future. And I'd like to get the reactions of this panel, and I thought, Mr. Stafford, we should start with you.
Look, I guess I find this debate about the earnings stripping and inversion stuff a little counterintuitive to me, because if you look at what we did, it's completely consonant with what President Trump's been talking about since he's been elected, which is keeping U.S. businesses in the United States. And the earnings stripping, that at the end of the day, the regulations issued by Treasury and IRS made it very, very difficult for companies to leave the United States and then reach back in and dividend out a note and start taking interest deductions to a fare-thee-well. Recall that in those regulations, if that foreign investor, whether it's an inverted company or not, makes a new investment in the United States, builds a new factory that employs workers, they're going to get their interest deductions. But those rules really were kind of a backstop to stop the drain of companies leaving the United States so that we actually have a corporate tax base about which to have the next debate about tax reform. So I'm actually, I think what we've done is very consonant with where the new administration is, and I don't understand why we give up the revenue and not have a backstop against foreign companies having an unlevel playing field with domestics.
Well, I would hope we would get tax reform this year. That would be the kind of tax reform where we could get rid of those regulations because they're not necessary anymore. And hopefully we'll at least get somewhat far in that direction through tax reform this year. If I were advising the Trump administration, I would put my emphasis on tax reform and not on doing anything with the regulations. Although I do think some of the 78, 74 related regulations don't make any sense, even in the context of trying to keep companies in the United States, particularly rules like the third country rule, which causes problems with real transactions that have real reasons, not just tax reasons for why you're doing. One of the things you have to understand that is just the way of the world is, I mean, we advise U.S. companies all the time on doing transactions with foreign companies, and it's very hard to describe a way that you could do those combinations with a U.S. parent company and not have a substantial dyssynergy in the transaction by reason of having a U.S. parent, because our current international rules forget any advantages from leveraging up or anything like that. It's just bringing the foreign company under the U.S. tax net. It has a substantial dyssynergy to the transaction that can only be avoided by having a foreign parent. And so with the kinds of rules that we have in 78, 74 that make it hard sometimes to do a transaction with a foreign parent, what it means is that the transactions just don't happen. And maybe that's okay. But it certainly isn't promoting economic efficiency. It would be nice if we can, through tax reform, get to a world where people like myself can advise companies that want to do a strategic deal, that they can do it either with a U.S. parent or a foreign parent, and taxes aren't going to drive that decision.
Just on that last point, the Treasury Department always said that these regulations were the best we could do with the authority we had to kind of stop the bleeding of inversions. But the Treasury Secretary also said we knew that our solutions were incomplete and we needed Congress to do tax reform. So I completely agree with Paul, but we never really saw this as this is just an ideal tax policy solution to a much larger problem that we're all talking about here today.
You're defining symptom versus disease with inversion. It's a natural response to the disease that we have. It's the symptom. And if we treat the symptom without treating the disease, we won't solve the problem.
You know, I obviously agree with that. I was not a fan of using Section 385 authority to address one of the key reasons behind inversions, which is to strip income out of the U.S. tax base. But it's plainly lawful, having that the regulations are plainly lawful, and in my view will be sustained if the challenge is fully litigated. But the reason that Treasury had to act, coming back to Bob's point, is, and I believe I can say this without hurting anyone's feelings here, since both gentlemen have stepped back from the Senate, is that it's all Congress's fault. Let's not mince around here. It is the Congress of the United States that has consistently abdicated its responsibilities to update the Internal Revenue Code, to close loopholes, or to overhaul the corporate tax system more generally. It is the Congress of the United States that writes that, in effect, has aided and enabled U.S. firms to engage in this gaming, that has created the opportunities for inversions by their lackluster response to the original wave of inversions. And it's the Congress of the United States that simultaneously decries the fact that U.S. firms inverts and how terrible that is, and then criticizes Treasury for trying its best to do something. We constantly take our eye off the ball in this country and let Congress get away with more than it deserves. We need to remember that that the Internal Revenue Code ultimately is a model of economic activity, and it is owned by Congress. and it is the responsibility of Congress to invest a little more energy in updating it.
Here, here.
Well, I've got a brother who's in the House of Representatives. This part of it will be off the record. I happen to agree with most of that. Congress bears a huge part of the responsibility. In terms of the question, I hope Congress doesn't make another mistake by repealing the regulations which have been put in place here in the areas of earning stripping. It's just another way of shifting revenue without changing any underlying economic activity. It's the earning stripping methods are just another way, another loophole to avoid paying taxes. That's all it is. There's no economic substance to it. It's just avoidance. Congress bears plenty of responsibility. What we allowed to happen with Subpart F was Congress's fault when we baked it in. By the way, the IRS made the first mistake on Subpart F with check the box. So there's a level playing field here in terms of where the responsibility is. But I hope Congress doesn't make another mistake by doing what it's considering here, which is
Since we're jumping on Congress a little bit, all you have to do is look at the tax extender packages each year. And 90% of that's a farce
yeah,
in terms of legitimate tax policy
Yeah.
for this country.
it's
And yet-
short-term political gain.
Yeah,
That's all it is.
It's all about the politicians, and it's not about our country. And that conflict of interest you see across Congress in all the committees, which is one of the reasons that we're in the trouble we're in.
In the last year or so, the European Commission has conducted a number of investigations and issued a number of orders requiring European governments like Ireland, the Netherlands, and Luxembourg to abrogate special tax arrangements they'd reached with certain corporations and instead apply their statutory tax rates. They claimed that those special tax arrangements constituted illegal state aid and disadvantaged the competitors of the corporations who didn't get them. In the most famous case involving Apple, they found that Apple had been paying a tax rate of 0.05% and hit them with an order requiring Ireland to collect $14 billion. Ireland and Apple, as I said before, are appealing the ruling. The U.S. Treasury wasn't too happy with it either. I guess I should ask Mr. Stack to start us off again, but if he would like to.
I mean, going to something Ed said about Congress and writing the rules, right? I mean, there's a lot to talk about, and I can't do all our state aid shtick in 3 minutes. But the first thing is, cost sharing, deferral. These were all the rules written by our Congress and our regulations of our Treasury and our check-the-box rules that permitted structures like that to work and still work. So that's kind of big point number one about that. I've reflected a lot. Last time I spoke on this, I got all exercise, so I have to try to keep my cool here today. I've reflected a lot on what drove me so much personally and then within Treasury about the state aid cases. And I think first and foremost is, my training as a lawyer or thinking about being a public official who's dealing in principles and rule of law, going to the OECD and trying to get other countries, developing countries, the Indias and the Chinas, to agree that when we set rules of the road, we're all going to live by them in a principled way. I think the atmosphere in which I was operating led me to feel extraordinarily disappointed and challenged by what we viewed as a, on its face, unprincipled new application of a rule to companies, no matter how popular they are, who had used existing structures to set up various regimes, and those structures are not limited to these companies. Many of the companies have them as well. So big number one was you don't set the example for the rest of the world by making up the fact that your law is X and it's always been X and you all should have been on notice, and now if you have a $14 billion bill, tough, you should have known. That seems to violate a sense of principle. And what we tried to talk about in our paper was, the Treasury paper, was the retroactive nature of this work, and secondly, the undermining. I was probably in Paris, I don't know how many times in the last 4 years at this OECD stuff, trying to get together, it's hard, it's like herding cats, on things we'll all agree to, and you undermine that when the EU, 22 of the 35 members of the OECD are EU members, when they go off and say, oh, well, there's a new arm's length standard, oh, it applies retroactively, the bill is $14 billion, And then the Europeans show up the next week and are like, well, what's the next thing we can collaborate on? How about the digital economy, huh? And so that second piece of undermining kind of international comedy is also very, very disturbing. I know it's hard, and it's very hard in Europe to get any finance ministers or tax people to look at this, in the governments anyway, because it's extraordinarily unpopular politically to look like you're defending a multinational, particularly a US multinational. But sometimes the right thing is the right thing. And a government should speak up because there are broader principles involved. And I think that's what we did at Treasury, and we're very proud of it.
The retroactivity of it is surprising and I think very uncalled for. You know, the Apple branch structure that they used was very common in Ireland. In fact, if you're going back to the 80s and the 90s, virtually everybody who did business with Ireland used that kind of branch structure. And the fact of the matter is all of Apple's R&D expenses were not booked in Ireland. They were booked nowhere. And so all that risk investment, which, you know, they went through a period of time when they had net operating losses. And they're not a client, but what I understand is they had net operating losses in the non-resident company because their R&D wasn't being very successful. I'm sure nobody would have brought a state aid case at that point in time. But it ended up obviously being hugely successful, and the risks were offshore Ireland, and therefore the rewards were offshore Ireland. It didn't seem to me to be terribly offensive that Ireland had agreed that that's the way the branch should be operated, because they agreed to it up front. Now the state aid is coming in after the fact and saying, well, you should have done it the other way around. You should have booked the expenses in Ireland all along.
So I disagree pretty strenuously with what Bob and Paul have said. First, state aid as a concept was not something invented in 2014 or 2015. State aid has been around as long as the current structure of the EU has been around. It has been applied in tax cases before. Second, the facts in the Apple case are just horrific from the point of view of Apple. And those facts, of course, were originally developed by Senator Levin and the work of the PSI in their exhaustive inquiry into Apple's international tax planning. And he deserves, you know, real kudos for all the work that was done, the extraordinary amount of work in developing those facts in a very complex and murky international structure of that firm. I don't find anything unprincipled in what the EC ruled. I don't find it undermining international world order. It's not a final judgment. It goes to the European courts. If in fact it is viewed as an inappropriate extension of state aid planning, the EC's judgment will be overturned. The idea that the United States needs to chastise the European Union on the rule of law is something that I find very distasteful. The European Union abides by the rule of law. What I do think is reasonably clear from the Apple case is first that the facts were appalling. You can read the facts. The fair inference of the facts are that Ireland said, give us some jobs and we'll give you a ruling that gives you cover to do what you want in Cupertino and book the income nowhere, thereby, in effect, raising the issue of where's the IRS? Why wasn't the Cupertino side of things pushed harder? And second, that the Treasury Department put itself in a very awkward position of championing the case of what, regardless of who should have gotten the income, of championing the work of a world-class international tax avoider, and did so primarily for the reason that the United States had some notion that it had first dibs on the income. Yes, we allowed Apple to engage in all sorts of stateless income planning, but one day that income would come back to the United States, and then it would be ours. And instead, those rascals in Europe have jumped the queue, and I reject that.
No, look, 2 points. We've just spent an hour talking about repatriation, and so I think the idea that it's a phantom that money will come back to the United States is just wrong, because we're going to be doing repatriation. And why would you let anybody have it who doesn't deserve it, number one. Number two, I think it's important for this group to understand the circumstances we were in when the state aid cases first came up. 1, 2, 3, McDonald's, 4. McDonald's, by the way, is not the only company that uses the structure that gets them the benefit, including European companies that are not being challenged, right? So if you're sitting in my chair, you're sitting there going, wait a second. Maybe we're never going to derail these 4 investigations and they'll go up to the courts. Fine, but how did we know that there's not going to be 44 U.S. companies rolled out on the carpet, big press conferences in Europe, taking money and causing expense and undue hardship to our companies, before we looked up and said, wait a second, what's going on here? And so I did conceive it as part of my job at the Treasury, my successor may not, to kind of look out for U.S. companies doing business around the world, that they were getting a fair shot in the tax space. And that's what we did, and I remain proud of it. I understand it's controversial.
Well, I'll just add one quick word here. I think we ought to be a little bit reluctant about criticizing the EU on enforcing their tax laws. That's what they say they're doing. Now, I'm not an expert on EU tax laws, but apparently the argument is that you can't make a special deal to give a 0.5% tax rate in order to attract a few jobs to whatever country it is. That's what they're arguing. I'm not about to say that's retroactive. They're saying that violated existing rules. That was a violation of our EU rules. You can't make special deals like that. You shouldn't have done that. They're going after it. I'm not about to sit here in judgment and say EU's right or EU's wrong, but I am here to say I think we are wrong in attacking the EU for what they say is enforcing their tax laws and not allowing special deals. That's what they're saying. I think we ought to enforce our own laws, a hell of a lot better, by the way, including transfer pricing, where I think a lot of folks have gotten away with murder. And by the way, you're an expert on this and I'm not, but maybe what you call the branch structure is common. It was, I guess, was a 0.5% common?
You're asking me.
Well, I'm not
I was
sure.
the one who was saying the branch
I don't
structure
know.
was
No,
common in Ireland.
I think it is.
And the answer is no, 0.5% wasn't common for precisely the reason that very few companies were as profitable as Apple ended up being after the fact. And so you
that's a special deal, and the EU's going after it.
No, it's not. I mean, I'm not an expert on Apple's facts, but as I understand it, Ireland basically gave them a cost-plus sort of arrangement in Ireland, which is pretty common. If that's what they did, then...
But the EU says that's not what they did.
Well,
they got a special deal, and we're sitting here judging.
No.
We're judging the EU.
They got a ruling. I don't know the details of that, Senator Levin. But the fact is, if they were just being judged on a reasonable cost-plus basis for the activities that were going on in Ireland, that's a pretty sensible way for Ireland to tax that once they agree that the IP is not part of the branch. And I don't find that particular construct. I mean, we have that construct in the United States with foreign companies that have branches in the U.S. where the IP is not part of the branch, and we don't tax the IP profits. We don't take the IP deductions. If the IP loses, then we don't have an NOL in the United States. If the IP wins, we don't have the profits in the United States. Sounds fair to me.
Just one comment. I know absolutely nothing about this subject, but I do love my Apple products, one. And number two, I want to tell you just a very short story on compliance internationally. I made a trip to Beijing to meet with the Commerce Secretary of China. His name was Bo Xilai. You all know where he is now. He's in jail because he challenged the administration. But I went over there specifically on WTO. Were they going to comply? And he's the most honest guy in the world. He said, no, we're not about to comply. So my point being is compliance is a sort of imagination because everybody sees it in the eye of their actions. And China hasn't complied on WTO, yet there's hardly any rulings against China on WTO compliance. So the fact is he's an honest abscounder of money of ours because they won't comply with WTO even though they're a signatory to WTO. Same thing's going on here.
Well, on that note, we want to open it up to the audience to see if we have a few questions out there. If you don't, I have plenty more. But if somebody would like to ask a question, Frank?
Can people identify themselves, Louise?
Yes, if you could please give us your name and your organization.
Hi, Frank Clemente, Americans for Tax Fairness.
You
Thank
might
you.
even want to stand up.
Oh, okay.
Make it easier.
Just thanks to Ed for getting my blood boiling. Greatly appreciate it. On the repatriation issue, it is. Where's the sense of outrage about this? I guess is really where I'm at. You know, you guys are talking very placidly, comfortably about the fact that, of course, they should pay a lower tax rate. And my view is that I guess my question is that all about politics, i.e., you need the lower tax rate because to get something through bipartisan, you're going to have to cut that deal, because from a ethical, intellectual, efficiency, every other point of view, it's outrageous. And what is upsetting, let's just take the Apple example. Here's a company we know, based on their SEC reports, that they are paying a 6% tax rate on their offshore profits. Microsoft is paying less than that. That means that all that money, the $215 billion that Apple has offshore, is in tax havens. It's profit shifted. We did a report on Gilead. They moved their Gilead Sciences, the sixth biggest drug company. You wouldn't know it, but it is. Hepatitis C cure charges $75,000 and $90,000 for this thing. It costs about $1,000 to produce. They changed their patent to Ireland. It's a U.S. patent. They shifted its domicile to Ireland in 2012. In 2013, they started producing this miracle cure. Profits went through the roof. Virtually all of its profits are showing up in Ireland. They're not showing up here in America. Why should they pay a low tax rate on repatriation?
I go back to what I said before, that U.S. multinationals, if we lived in a world where all multinationals were U.S. multinationals, worldwide taxation would make perfect sense. That's just not the world we live in. And so if you care about having multinationals that are based in the United States, then you have to keep an eye on how unleveled the playing field is between U.S. multinationals and foreign multinationals. And Gilead is a pharma company. That you look at the leading pharma companies in the world outside the United States, and two of them are based in Switzerland, two of them are based in the UK, where they have a rate going down to 17% and a patent box that was specifically designed for them that's 10%. So that's the real world out there. And we can be as harsh as we want to on U.S. multinationals, but you have to be aware of the long-run consequences of doing that in a world where their competitors are in a much different place.
Two other observations on the real world. First, tax rates are not the sole competitive determinant of lots of things. So if we're thinking that our rate has to be the lowest so that our companies can compete the best, we're never going to get there for a variety of reasons, but nor is it the sole determinant of competition. Second fact about the real world is, in the United States politically, many other countries have come up with alternate revenue sources to the corporate income tax to take some pressure off the corporate income tax, whether it be a VAT or a carbon tax. Those are not part of our political reality. So you're seeing that flow through to the destination-based approach, which is kind of maybe a hybrid VAT because we can't have a regular VAT, perhaps. And you're also seeing it, I think, in terms of this extraordinary pressure on what the corporate rate's going to be. So we live in our own reality as a political country. I do think, by the way, the repatriation rate is not so much a moral question as a political question, because we've got to get some people to agree on what it is. And I think that it's a false notion that our competitiveness demands on us participating in a race to the bottom in corporate income tax while we're not willing to find alternative sources of revenue.
Well, on repatriation, my blood runs too. But if it's going to happen, and there's broad bipartisan support for it, if it's going to happen, and remember, folks, in the real world, the one that Tom Coburn and I just left,
Real in quotes, right?
No, we just left it for about 2 minutes to come here, but because this is a very philosophical, theoretical discussion. In the real political world, repatriation is a huge, huge attraction. And my greatest fear is that it's going to happen without closing the loopholes that allowed it to happen to begin with. I'm going to repeat that, I'm afraid, for the third time. But I think that's the real issue politically. And so, I'm afraid you're going to face it, Frank, too, as well, from your perspective. And then the question is, if you had a package there which said, we're going to repatriate it, whatever the rate is, we're going to get this many tax dollars, we're going to use it for some good purpose. I'll let people argue about that. I think infrastructure is a good purpose. But we will not let it happen again. We're going to close the loopholes that allowed it to happen. I say that's about as good a deal as you're going to get in that real world that Tom Coburn and I just left.
Yes.
Moi? Okay. Pamela Fuller, I'm an international tax attorney in New York and Washington, D.C.
And I think one of you had characterized OECD's anti-BEPS project as kind of like sticking the finger in the dike and placing Band-Aids on a bigger problem. Maybe it was Bob Stack, I'm not sure. But I wanted to ask anyone that wanted to comment, don't you think that actions 8 through 10 that require companies to align their transfer pricing with real value creation has had an effect on the passage of domestic legislation in various European countries? We're seeing the disappearance of like patent boxes in Switzerland. A lot of countries seem to be adopting the modified nexus approach. Does that give you any hope that perhaps some of these incentives are disappearing through a multilateral, a soft law, multilateral approach?
No. And seriously, and the reason is, look at at modified nexus in the context of the patent boxes.
Maybe you could explain what it is first.
Well, the patent box is just the idea of giving intangibles a special tax rate in order to encourage firms to leave their intangibles in the jurisdiction in which the multinationals, the principal residence is situated, or to move them into that jurisdiction. And the modified nexus idea is the idea is simply that that you can't have a naked patent box, that you've got to actually add some value in that jurisdiction. Look, I'm very pleased no longer to be in private practice, but from what I've read and observed, my impression is that it's a relatively weak standard. I do agree with the larger observation that European countries in particular are getting much more serious about their domestic tax legislation, and that is a good thing. But in the end, I remain skeptical that the BEPS package, which was the best that could possibly be expected in the time allotted, is going to be sufficient to the task.
One of the reasons I got involved with Ellen Arbeck and Mike Devereaux on destination-based taxes was my frustration at being a practitioner in the United States for many years, where in order for companies to have tax efficiency with respect to their international income, you had to encourage them to do their manufacturing outside of the United States, because under Subpart F, manufacturing can be exempted from having the income come back, whereas if you just do something that is paper and not real manufacturing, you had a harder time avoiding Subpart F. And so we did see, now granted, there are a lot of reasons besides taxes why manufacturing moves outside the United States, but in the world I've lived in over the last 30 years, the tax law certainly was a tailwind pushing manufacturing out of the United States, along with other economic factors. And what I worried was that actions like Actions 8 to 10, which say if you're going to have income outside the United States, you got to have the people who manage the income outside the United States, is going to lead the next generation of tax lawyers, if we don't do anything about it, to say, no, you've actually got to move more people outside the United States in order to justify the income. And companies will do that because taxes are such a big number on companies' profit and loss statement that if they have to move 10 or 20 or 30 more people outside the United States in order to justify the $100 million of tax savings that they have, of course that will happen. And I understand the desire in OECD to have substance and not paper, if you will, to various operations. But be careful what you wish for, because taxes are so important that if substance needs to go along with the structure in order to get the benefits, then people will move, or people will be hired, and growth will take place more outside the United States. So that's why having a focus on some proposals that take the pressure off of transfer pricing by allowing us to get our corporate rates down, and in combination with the fact that some of the, as I said before, some of the places where you could get zero income tax rates before are pretty dramatically going away and will largely go away over the next few years. We can get it more into balance, but we need to get the U.S. rate down at the same time that some of these foreign rates are coming up, or else we are going to see a migration of activities.
Hi, Bill Parks. I'm a founder president of NRS, 100% employee owned, and a retired professor of finance. And I'd like to talk about what I could consider the vast corporate conspiracy, and that has to do with the academics, the Treasury, and the politicians. I noticed in the list that, at least being put up, that it did not list sales factor apportionment as a realistic thing. And thanks to Ed Kleinbard, he nodded to it, but again, you mixed it up with the cash flow, and I just like to suggest, I've put out a short paper. If you didn't get one, I'll give it to you on the way out. Also, sales factor apportionment.org has more information. So my question is, for instance, when you talk about lowering the rates, why do you need to lower the rates if you use sales factor? Because then the rates are independent of who you are and where you are. It does not need to be a lower rate if all companies selling in the United States are paying the same rate. And lastly, people kick around all of these numbers and various things which I don't understand. And I would say that on the ground, if you don't know what the nasty notch is, you don't understand corporate taxes for the small and medium-sized business. And when I flew here, I sat next to a person with a company that's paying full tax, and they're competing with General Electric. And that's not fair. That needs to be talked about.
Okay, I co-authored an article with Joe Andrus that should be coming out in Taxes Magazine next month, but that starts out talking about what happened in OECD and the topic I was referencing about how that could encourage a further movement of activities. And so if we're going to keep a high corporate tax rate, maybe we should look at some of these alternative, including sales-based apportionment. I think there are better ways to do it than a pure sales-based apportionment because there are a lot of issues in the location of sales, in how you treat capital goods purchases, and how you treat intermediate goods, and how you deal with remote sales. There are just a lot of problems with it, which the article will get into. But I don't disagree with at least the thought that in many cases, the location of the customer is less mobile than other factors, and so having sales be a increased factor in how we allocate income among jurisdictions can be a direction to go in if our tax rate is going to stay high. Hopefully that won't happen.
You know, a large number of articles have looked at this question, pro and con. the academics are split, so that, if they're in a conspiracy, somebody forgot to tell them. The issue is, the idea is a serious one. It shouldn't, there are parallels between the destination-based cash flow tax, the House blueprint on the one hand, and sales-based apportionment factors on the other. One big difference is what is the base. A cash flow base is different in some important respects from an income tax base. And there are a lot of practical difficulties with a sales-based apportionment formula along the lines Paul's already described. But there is another issue, which I think Bob mentioned in passing, that we need to come back to, which is if the purpose of a multinational firm is a global platform for the exploitation of supernormal returns, which I think is a pretty fair description of the raison d'etre of a multinational, then we have to ask ourselves, is a destination-based system or a sales factor apportionment, either one of those giving up too much of our tax base? We have the great good fortune in this country to have the leading technological innovators in the world in firms like Apple, Google, Microsoft, Facebook, and so on. And when you move to a destination-based system or a sales-based apportionment formula, you're effectively making the customer king, and that means that profits attributable to the innovative ideas developed in the United States will not be taxed in the United States to the extent that their ultimate sales or exploitation is outside the United States. That has always struck me as an issue we need to think more seriously about. It's one of the reasons why, another reason why, in the right tax at the right time, I go the other way with a super origin-based system. But that's a debate that we may have overlooked in the panel discussion so far.
I just have a quick comment on Bill's last point about the smaller businesses in this country, and they need a level playing field too. And we've talked a lot about the multinationals. Between our multinationals and foreign multinationals need a level playing field, and that's true. And we have expressed concern about it. We always ought to be concerned about it. But we also need a level playing field inside the United States between our smaller businesses and medium-sized businesses who can't shift their revenue to tax havens. They don't control foreign corporations. They transfer their intellectual property, and they are paying a higher tax rate than a real effective tax rate than the bigger corporations who are able to shift their intellectual property to themselves through transfer pricing and other mechanisms in tax havens. And I'm glad you raised that point. I think it's a critical point.
Any other questions?
Thank you. My name is Ed Keenum with a firm called the Observatory Group, and this is a question I guess I would direct at Senator Levin and Senator Coburn, who I guess is no longer here. So some of the panelists highlighted with regard to the destination-based cash flow tax or the border adjustments, some of the panelists highlighted the uncertainties or the question marks surrounding how the foreign exchange markets will react if something like that is introduced. And I guess my question is, if you have these uncertainties and question marks about how something like the foreign exchange markets will react to that kind of a proposal, how is that going to affect the willingness of members of Congress to consider even pursuing the proposal?
Well, my own sense is that they're going to need to be very cautious about the impact of this proposal. It's very uncertain as what that impact is. They ought to go very slow, it seems to me, move very slowly in doing it. I mean, as I understand it, and it's much more complex than my usual understanding, is that it's basically attempting to subsidize exports and penalize imports. Other countries have done that, and we've protested. When I remember representing a state with an auto industry saying, our big three aren't competing with companies in other countries, they're competing with countries, governments that are subsidizing. supporting those industries. Well, if we're going to walk down that road, it seems to me we're probably going to find all kinds of retaliation in other countries. They're going to do the same thing. They're not going to stand still while we, in effect, subsidize our exports and punish our imports. You're going to see a response in other countries. So I would hope that the Congress would think through very carefully what the implications are and move very slowly.
We're going to take one last question.
I'm Stuart Gibson from Tax Analyst. I have a question for Professor Kleinbart. Your criticism of was on the destination-based part. And I guess the question that I have is, you're assuming that there would be stasis, that there would be no reaction by any other country in the world to move to this kind of a system. And if you look at in the UK where they have the DBT, where they've said, we're going to assume so much of the profit of multinationals is earned in the UK and we're going to tax it. Would you have a different view of the destination-based part of the House Blueprint proposal if you had some indication that other countries would move in reaction to it to adopt a similar program, which would then create a field where the competition was on the basis of rates and not how businesses happen to create their structures?
Look, there's a lot to like in the destination-based cash flow tax. There are issues there are also issues associated with it. If the United States moves first and unilaterally, those issues are greatly compounded. If other major economies follow and rewrite their corporate tax to suit the destination-based cash flow tax, some of those issues, the United States, as the new Luxembourg, dissipate. But the other issues remain. The wealth transfer issues remain. The question of whether we're giving up too much of our tax base, those all remain. There's no question but that this is an extremely serious and interesting proposal, but it has significant side effects that are greatly exacerbated in a world of unilateral action. Obviously, we know that other countries are strategic players. They will react in some fashion. The first way they will react is by characterizing this as a clear violation of WTO rules and create a trade crisis. Why that's in the interest of the United States is beyond me. At some point, in a world where everybody adopts this, everybody agrees that it's compliant with WTO, well, that is an interesting hypothetical world that I am not sure that I'm young enough to live to see.
Well, I think what we want to do now is give all of our panelists just a few minutes to make some closing remarks. We've had a terrific discussion hitting a lot of different issues, and I'm hoping they can give us some thoughts to the next few months as Congress begins to wrestle with these tax reform issues, and if they have some advice and guidance for Congress as it begins this work.
Well, I'll go back to my opening statement. A lot of our discussion surrounded the fact that there's a lot of symptoms out there making a lot of noise that we tend to get our direction and our attention, and we ought not to be paying attention to this. We ought to, what's the best capital formation? Where does it create the most wealth? And how do we have a tax code that doesn't misdirect that capital formation? Because ultimately, we will all benefit if, in fact, tax capital is free to flow for the greatest return. The other thing is we ought to think about why we have such a complicated tax code. I mean, we've talked about some pretty serious, difficult issues here in relationship to other countries. To me, it would seem smart if we actually, what I see is competition, a race to the bottom. I think that's happening right now. I don't know if my learned colleagues would agree with that. But all you have to do is look at Ireland and the things they're doing and the advantage that they've created. So I would think that we would want to get ahead of that and make our code as simple as we can make it, as cheap as we can make it, and then stick with it, and then trust the economic engine of this country to provide the resources necessary for a limited federal government, not the one we have now.
Well, obviously, I'm not a fellow traveler with Dr. Coburn on the limited federal government. You know, my book argues exactly the opposite, that our government today does too little for us, but that's a different forum. I would argue, if you were to take a step back, that the work of the House Blueprint and the tremendous amount of very high quality academic work that lies behind it is extremely interesting and important, but it ought not to be the base case for tax reform. It is radical, it has all these knock-on effects. The base case really already exists in the form of the work product of Dave Camp, which is a 900-odd page legislative draft on business tax reform that is an incremental kind of reform of the sort that is much more digestible to Congress. I find it difficult to imagine members of Congress putting their political future in the hands of the currency markets, because if the magic doesn't work, Joe Consumer does pay more at Walmart. And I therefore just don't understand why something along the lines of Camp 2014 isn't the base case, and we talk about this as a possible alternative. As long as we're going to talk about really radical new alternatives, I would not object if people threw mine into the hopper as well.
Well, I guess would hope that we are more bold than going back to Camp 2014. I think, you know, that proposal was not something that is, certainly the Joint Committee didn't score it as encouraging economic growth from the business tax proposals. If I recall, the Joint Committee's analysis was that the only thing in it that encouraged economic growth was lowering the rate of tax on individuals and maybe stimulating a response in terms of labor rates. But at any time you are lowering corporate rates by slowing down depreciation, capitalizing and amortizing R&D, and slowing down other timing deductions, you're doing two things. One, you're rewarding old investment and discouraging new investment. And what's the point of that? And you're paying for permanent rate reductions with timing differences. And is that really where we want to be? If you think about it a little more boldly and think about the cash flow tax that Ed was talking about, you do just the opposite. You reward new investment, and depending on the rate and what you do in the transition, you may be taking a hit on old investment, but old investment is already sunk. And so moving in the direction of not in the direction of Camp, but in the direction of a cash flow tax, to my mind, would be, it ought to be where we're looking if we do want to encourage economic growth in this country. And then we can talk about the extent to which it should be destination-based. It seems to me having a substantial portion of it be destination-based, not necessarily all of it, and phasing it in slowly. And Congress meets every year, and hopefully Congress can be better than they've been the last 4 years in terms of actually responding to things. But it seems to me is an experiment that we ought to give serious consideration to.
I think I'll go back to where I started in one respect. When I was in Treasury, I was struck, I kind of learned I was not really a lobbyist in my prior life or somebody who came in and talked to folks at Treasury in my position. And I was struck by how often companies came in and with the equivalent of, we'd like to pay less tax. And that was really the sum and substance of the technical argument they were making. And, you know, one of the things sitting in the government seat you realize is you've got these broader policy things to be thinking about, which is, are we going to have the revenue to meet the long-term needs, fiscal needs of the country in a fiscally responsible way? What are the distributional effects when you're shifting around tax burdens? Who's getting the benefit and who's taking the bite? Particularly in times when there's focuses on things like fairness and equality. And I just think that this debate, we really can't lose sight of those issues, because one of my other perceptions, again, from government was that a lot of people in this community take these very narrow views of you know, a particular issue, a particular fix, a particular thing that might benefit their industry or company, But there's a much broader question that we as Americans have to be asking ourselves. And all these ideas are good, worthy of sound thought like we've done today, and everybody should be engaged in the debate, and there are a lot of good people who are. But at the end of the day, there are some very core questions we need to hold all these tests up to, and I just invite us all to step back and ask, are we able to fund our government, meet our needs of the people, and is what we're doing fair, and then shape the other work into a rubric like that.
Well, my advice to Congress would be to avoid labels on complex issues. Think long-term, not just short-term. I would urge them to look at the distributional effects of any tax reform. I'm glad you mentioned that. It hasn't been mentioned enough here today. These tax laws will have effects on income distribution. We already have a huge income gap, which I consider to be totally unacceptable in this country, and that is a factor in any tax reform. I think that hopefully that Congress will proceed in a bipartisan way, because these issues should not be resolved on a purely partisan basis, and there's much too much of that obviously already, and perhaps somehow or other, because this is such a complex issue and really does not lend itself to a partisan response. Maybe Congress could use this as a way of approaching a very complex issue in a bipartisan and thoughtful way. I want to thank again everybody for participating here today. I think the way in which this has been set up, this forum, this discussion, is really a model for how this kind of discussion should take place. And the final thing, which again, I would urge in terms of short-term, long-term, I think that to end where I began, that there's a pot of gold out there. And Congress can be tempted on a bipartisan basis, I'm afraid, to seek a short-term pot of gold. And bringing back a couple $1 trillion for tax purposes is long overdue one way or another. But unless it is done in a way which prevents it from happening again, this absurdity of trillions of dollars sitting offshore, not really, but offshore for tax purposes, to allow that to continue, it seems to me would be the worst of all outcomes. It would not be a pot of gold, it would be fool's gold. And so we have a long-term reform which is needed. I think the tax code is clearly broken. We need that comprehensive reform, but there's that short-term attraction, which I think we have to be very careful of in dealing with.
I'd like to thank our panelists. I think this has given hope to all of us that we can have a thoughtful, bipartisan discussion of these very serious issues, and that there are a lot of ideas out there and ways to go about this. I want to thank everybody here for their participation and for giving us some guidance and your thoughts. We really appreciate it, and I want to thank the audience for your participation as well. So thank you very much.